Coloplast AS, Colo B, represents a fundamentally high-quality medtech investment, primarily characterized by its exposure to highly defensible chronic care markets. The firm's investment profile is buttressed by a wide economic moat rating from institutional analysts 1 and a history of sector-leading capital efficiency metrics, exemplified by an average 5-year return on capital employed (ROCE) of 39.5% against a peer average of 10.5% 2. These structural advantages justify the persistent valuation premium observed in its trading multiples. Despite its underlying quality, the firm recently concluded its Strive 25 strategy, which management acknowledged did not deliver the value creation we had envisioned. Fiscal year 2024/25 demonstrated resilience but was marked by operational headwinds, delivering 7% organic growth and an adjusted EBIT margin of 28%. This performance was in line with revised guidance but fell short of initial expectations due to issues such as product recalls and market volatility in its biologics division 3. The investment case for Coloplast now pivots entirely on the ambitious 5-year Impact4 strategy, FY 2025/26 through FY 2029/30. This plan targets an accelerated organic revenue growth CAGR of 7 to 8% and, crucially, a return on invested capital (ROIC) exceeding 20% by FY 2029/6. The primary opportunity lies in the successful execution of this margin and capital efficiency expansion, particularly through leveraging recent U.S. market penetration strategies and driving product catalysts such as Intibia in interventional urology. 6. While current multiples, such as a price-to-earnings ratio (PE) of 32.5x, 8, price in high expectations, the current enterprise value to earnings before interest, taxes, depreciation, and amortization (EV/EBITDA) multiple of 18.9x, 9, trades near historical troughs, suggesting that investors view the recent operational challenges (recalls, China slowdown) as temporary setbacks rather than structural deficiencies. 2. Successful strategy execution, particularly achieving the ROCE target, is required to unlock significant upside potential. I. Company overview and market positioning. Coloplast's core purpose, guided by its mission to ease life for individuals with intimate healthcare needs, has been the foundation of its operations for nearly 70 years. The company supports over 2 million users worldwide. This intimate focus results in a highly defensible revenue profile, with chronic care exposure accounting for approximately 80% of revenue. These markets are characterized by high revenue stickiness and long patient treatment spans, averaging 10 years. Economic moat and competitive advantage. The wide economic moat assigned to Coloplast 1 is derived primarily from high switching costs and brand loyalty inherent in the specialized nature of intimate healthcare products. Patients utilizing ostomy, continence, or laryngectomy solutions often experience significant physical and psychological friction associated with switching brands, reinforcing Coloplast's market position. The firm's ability to consistently generate returns significantly above the weighted average cost of capital validates this fundamental competitive strength. Geographical revenue segmentation. Coloplast's revenue base remains heavily weighted toward mature developed healthcare markets, where reimbursement systems are stable and penetration of chronic care solutions is high. Total reported revenue in FY 2024/25 reached DKK 27,874 million. The segmentation highlights the importance of the European and other developed markets in providing the core earnings base. The reliance on European markets, DKK 15.5 billion, provides stability, but the emerging market segment, DKK 4.5 billion, introduces specific volatility. For instance, sales in China experienced a notable decline due to a combination of worsened consumer sentiment and increased competitive pressures. This volatility in emerging markets counteracts the firm's focused strategic growth efforts in higher value developed markets such as the US, potentially slowing the overall global growth rate and demanding greater managerial resources to navigate local competitive landscapes or adjust pricing strategies. Conversely, the U.S. remains prioritized as the largest opportunity for driving market share gains in chronic care. 11. I. Financial Performance Review, FY 2024/25. Growth and profitability. Coloplast delivered total reported revenue of DKK 27,874 million in FY 2025, representing 3% growth in Danish krone (DKK) terms. Organic growth, which excludes currency and structural impacts, was 7% for the full year, meeting the revised guidance. Reported growth was negatively impacted by adverse currency movements and the strategic divestment of the skincare portfolio, a move undertaken to simplify business operations and enhance profitability within the advanced wound care segment. 5. Profitability demonstrated progress, with EBIT before special items rising 5% from the prior year to DKK 7,670 million. This resulted in an adjusted EBIT margin of 28%, a 100 basis point improvement over the previous year. This margin restoration signals initial success in the firm's cost containment measures. 1. However, the reported results included DKK 469 million in special items expenses, primarily related to profitability improvement initiatives, management restructuring, and the integration costs associated with Atos Medical. 4. Capital efficiency and cash generation. Capital efficiency metrics remain solid, with the adjusted return on invested capital, ROCE, after tax holding steady at 15%. Looking ahead, guidance for FY 2026 anticipates a modest improvement, projecting ROCE around 16.5. A significant achievement was the material enhancement in cash conversion, with the adjusted free cash flow to sales ratio improving dramatically to 19%, up from 15% in the previous year. This jump in cash conversion indicates robust operational improvements, potentially stemming from optimized inventory management or enhanced collection cycles. This optimization appears synergistic with Coloplast's sustainability commitments. In FY 2025, the firm achieved a 41% decrease in absolute Scope 1 and 2 emissions compared to the base year. This substantial reduction was driven by the continued phase-out of natural gas and the transition of the company car fleet to electric vehicles. The successful implementation of energy efficiency improvements not only addresses environmental, social, and governance criteria, but also directly supports the long-term financial ambition of Global Operations Plan 7 to be gross margin accretive and enhance cash flow. The operational savings derived from these efficiencies strengthen the overall investment proposition. Coloplast continues to invest in scaling capacity, maintaining a capital expenditure (CapEx) to sales ratio expected to be around 5%. Furthermore, the effective tax rate is projected to be around 22%. In terms of shareholder returns, the total dividend for the year was increased to DKK 23.0 per share, up from DKK 20. Segmental performance and growth vectors. The overall 7% organic growth figure for FY 2025 masks significant divergence in performance across Coloplast's 5 core business areas. The core chronic care segments provided the primary acceleration, while interventional urology remained the notable drag. Chronic care core and voice and respiratory. The 2 largest segments, Continence Care and Ostomy Care, demonstrated solid growth driven by strategic market penetration and product innovation. Continence Care was the leader among the core segments, achieving 8% organic growth. The key accelerant in this area was the continued strong contribution from the Luja intermittent catheter product line, serving both male and female users. Ostomy Care reported 6% organic growth. Growth momentum was significantly bolstered by aggressive market share gains in the U.S., underpinned by key group purchasing organization (GPO) wins over the past 2 years. Coloplast has secured access to GPOs covering approximately 75% of acute accounts in the ostomy care sector in the U.S., notably Vizient and Premier. These GPO contracts, typically multi-source alongside rivals like Convatec and Hollister, establish a level playing field in acute settings. Importantly, these acute share gains are expected to translate into sustained long-term community share. The firm aims to offer the most comprehensive portfolio, including Sensura Mio. 6. Voice and respiratory care, largely comprising the integrated Atos Medical business, maintains strong momentum with 9% organic growth. This segment is successfully accelerating Coloplast's reach in both laryngectomy and tracheostomy markets. Coloplast estimates its global market share in the tracheostomy market is around 10%. Advanced wound and tissue repair delivered 8% organic growth. 4. The advanced wound dressings component was primarily driven by performance in Europe. 12. Strategic focus dictates achieving double-digit growth in WTR over the Impact 4 period. 6. The Kerecis Biologics unit initially saw strong growth, 32%, but experienced a slowdown in the second half of FY 2024-25, 12. This deceleration was attributed to increased volatility in the biologics market, specifically the postponement of U.S. healthcare reforms regarding specific treatment pathways. 3. However, Kerecis was included on the final local coverage determination policy scheduled for implementation in April 2025, 12, suggesting that regulatory clarity and renewed growth momentum should return. Interventional Urology, IU, challenges. Interventional urology was the clear weak spot, achieving only 2% organic growth. 1. This performance was significantly impacted by a voluntary product recall in bladder health and surgery, which incurred an approximately DKK 25 million loss. 3. Sales of the affected products are anticipated to resume during the subsequent fiscal year. 12. The interventional urology segment is crucial for growth, with the Impact 4 strategy planning to transform women's health through the anticipated launch of Intibia. 6. A pre-market approval (PMA) submission for Intibia is expected in H1 2025-26, targeting a product launch in H1 2026-27, contingent upon FDA approval. 6. Strategic conversion in the U.S. market. The U.S. market success demonstrates Coloplast's strategic transition from a market defender to an aggressor, particularly in chronic care. The U.S. GPO access expansion in Ostomy Care, covering approximately 75% of acute accounts, provides a strong foundation for sustained community share gains. 7. Furthermore, the strategic importance of the 2026 regulatory changes in Continence Care is profound. The Centers for Medicare and Medicaid Services, CMS, issued a final coding decision that introduces new, dedicated reimbursement codes for hydrophilic intermittent catheters, effective January 1, 2026. This development structurally favors premium, innovative products like Coloplast's Luja and SpeediCath Soft over older catheter technologies. By actively driving the upgrade to hydrophilic catheters and setting this new standard of care, Coloplast leverages its innovation to create a long-term structural revenue accelerator in the largest global market, solidifying its competitive position in continence care. V. The Impact 4 Strategic Plan, FY 2025-2029-30. The launch of the Impact 4 strategy represents a decisive pivot following the relative underperformance of the preceding Strive 25 strategy. 3. This new plan establishes explicit, aggressive financial and operational goals spanning 5 years. Long-term financial ambition. The primary financial mandate under Impact 4, extending towards 2030, is focused on accelerated shareholder value creation. 6. Key targets include organic revenue growth, achieving a compound annual growth rate, CAGR, of 7 to 8% over the period. 6. Profitability, delivering absolute EBIT growth that is in line with or exceeds revenue growth, implying a clear path toward margin expansion. 6. Capital efficiency, achieving an ROIC of more than 20% by FY 2029-30, with management expecting a linear improvement throughout the strategy period. 6. The required acceleration of ROIC from the current 15% FY 2024-25 to over 20% by 2030 is the single most critical metric underpinning the firm's structural premium valuation. Achieving this requires simultaneous delivery on the 7 to 8% organic growth target and aggressive margin expansion, EBIT growth exceeding revenue growth. This margin capture will rely heavily on improved operating leverage and the realization of cost synergies following the Atos Medical integration. 1. Strategic growth pillars. Impact 4 outlines clear mandates for each segment. 6. Chronic care. The goal is growth above the market rate across all core business areas, leveraging comprehensive portfolio offerings. Ostomy Care with Sensora Mio, Continence Care with Luja. 6. Wound and tissue repair. A specific target of approximately double-digit growth, relying on market penetration and the stabilization of the Kerecis biologics business. 6. Interventional Urology. Focus remains on building strength in men's health while transforming the women's health segment via the high-potential catalyst in tibia. 6. Operationally, the firm is launching Global Operations Plan 7, which spans the Impact 4 period. This plan is designed to be gross margin accretive and enhance cash flow through optimization of the supply chain, including inventory reduction and maintaining a disciplined capital expenditure regime, CapEx to sales target around 5%. 6. Furthermore, the operational focus includes reducing the net debt to EBITDA ratio over the period toward FY 2029-30. 3. The DKK 469 million in special items expenses in FY 2024-4 represent a strategic reset cost following the conclusion of the underperforming Strive 25 period. 3. These significant expenses related to restructuring and divestment initiatives are intended to simplify operations and enhance future profitability. 4. The market expects a rapid and complete cessation of these special items in the immediate years of Impact 4 to validate the efficacy of this foundational cleanup effort, which is essential for demonstrating the linear ROIC improvement expected by 2030. V. Competitive landscape and regulatory dynamics. Coloplast operates in a competitive environment, particularly in the core ostomy and continence segments, where key rivals include Convatec and Hollister. 7. The competitive dynamic is most intensely played out in the large, profitable U.S. market, identified as the largest opportunity for Coloplast to drive chronic care market share gains. 11. U.S. market penetration and competitive levers. Coloplast's success in gaining access to major GPO contracts, Vizient and Premier, covering approximately 75% of U.S. acute accounts, 7, is pivotal, ensuring that its products are available to a broad spectrum of patients during their initial postoperative phase. These contracts, while often multi-source, provide the foundation for converting acute care users into long-term community care customers. 7. The strategic importance of regulatory tailwinds in the U.S. continence care market cannot be overstated. The CMS final rule, effective in January 2026, introduces 3 new dedicated reimbursement codes for hydrophilic intermittent catheters. 7. This development structurally elevates the reimbursement for advanced products like Coloplast's Luja and SpeediCath Soft relative to older straight catheters. 7. This policy shift represents a long-term structural advantage, far outweighing the DKK 25 million short-term revenue loss sustained from the IU product recall. 12. By positioning itself as the leader driving the upgrade to hydrophilic catheters, Coloplast is effectively shaping the standard of care in the U.S. market, solidifying its competitive moat through innovation and favorable regulatory alignment. Managing regulatory risk. While the CMS decision provides a strong tailwind, the company is exposed to regulatory volatility, as seen in the wound care biologics segment. The temporary slowdown in Kerecis momentum during H2 24-25 was directly linked to the postponement of U.S. healthcare reforms regarding specific treatment areas. 3. This highlights the need for careful management of regulatory exposure, particularly in high-growth newer segments. Coloplast maintains a high commitment to regulatory compliance, evidenced by approximately 125 audit days dedicated to balancing compliance requirements with the necessary business agility in a dynamic regulatory environment. 11. Furthermore, the establishment of its manufacturing site in Portugal ensures sufficient capacity to support anticipated growth and meet global demand, providing supply chain resilience. Risk assessment and mitigation. Despite its defensive market position and high-quality fundamentals, Coloplast faces several critical risks that could impede the successful execution of the Impact 4 strategy. Operational and execution risks. The most immediate risk stems from operational execution failures. The voluntary product recall in interventional urology significantly hampered FY 2024 performance. 3. While sales of affected products are expected to resume and quarterly comparisons will ease, 1. Any recurrence of major quality or supply issues would severely erode investor confidence and challenge the margin expansion goals.
Additionally, the firm is navigating a critical leadership transition, with Lars Rasmussen currently serving as interim CEO, following management changes designed to enhance execution efficiency. The timely identification and appointment of a permanent CEO is necessary to eliminate uncertainty regarding future strategic decisiveness. Finally, the successful capture of synergies and margin accretion from the Atos Medical integration is vital to validate the value of that acquisition and meeting the impact targets.
Market and commercial risks. Commercial risks include increasing competitive pressure in emerging markets, exemplified by the decline in China sales attributed to intensified local competition and weakened consumer sentiment. 10. Coloplast must demonstrate effective strategic adjustments to defend its position in these large, growing markets. Furthermore, the volatility observed in the Kerecis segment indicates ongoing sensitivity to the timing and implementation of U.S. healthcare policy, requiring flexible commercial strategies. Financial and valuation risks. Coloplast's financial outcomes are exposed to heavy fluctuations in the exchange rates of important currencies. While the company hedges a significant portion, 61%, of the following 12 months of net cash flows, 3, currency risk can still negatively impact reported revenue and earnings. Perhaps the greatest financial risk lies in the stock's steep valuation premium. Trading at 32.5x PE, 8, the market demands near-perfect operational delivery. Any sustained failure to hit the 7 to 8% organic growth target or to demonstrate clear linear progress toward the 20% ROIC goal would likely trigger a severe re-rating and stock price correction. However, the DKK 469 million in special items expenses incurred in FY 2024-25 should be viewed as a high-cost but necessary prerequisite for the targeted margin expansion. The investment premise rests on the assumption that these one-time expenses have effectively cleaned the slate, enabling a focus on operational excellence required to achieve the long-term ROIC goals. 8. Valuation and investment recommendation. Historical and peer multiple analysis. Coloplast consistently trades at a significant premium relative to its medtech peers and the broader healthcare sector, reflecting its wide economic moat, 1, and superior defensive business model, chronic care stickiness, and high ROIC. Coloplast valuation multiples versus peers and sector benchmarking, LTM. The valuation multiples confirm a structural premium. Coloplast trades at an 8.0x price-to-book multiple, nearly 4 times the peer average of 2.2x. 8. However, a historical comparison reveals a moderation in valuation expectations. The firm's current LTM EV/EBITDA of 18.9x, 9, is significantly below its 5-year average of 28.4x, and is also lower than its 5-year low of 24.5x recorded in September 2023. This historically depressed valuation multiple, relative to its own history, suggests that the stock currently reflects the aggregated uncertainty surrounding the CEO transition, the product recall impacts, and the failure of the Strive 25 strategy. The premium over peers is justified by the fundamental strength, but the discount relative to its own history implies a substantial valuation gap that can be closed through successful execution. Analyst sentiment and path to value unlocking. Analyst sentiment is generally cautious but leaning positive, with 7 buys, 15 holds, and 2 sells. 15. The consensus price target of DKK 675.58 implies approximately 15.37% upside from recent closing prices. 16. More aggressive institutional estimates, such as Morningstar's fair value estimate of DKK 962.1, suggest the shares are significantly undervalued. The analysis concludes that Coloplast is a buy, predicated on the success of the Impact 4 strategy in driving margin restoration and ROIC expansion. If the firm achieves its goal of greater than 20% ROIC, demonstrating that the operational setbacks of FY 2024-25 were temporary, mean reversion in its EV/EBITDA multiple toward its historical median of 27.3x, 9, is highly plausible. This multiple expansion, combined with the projected 7 to 8% growth rate, creates a scenario for substantial shareholder value creation and justifies the ambitious price targets suggested by bulls. 9. Conclusion and investment recommendation. Coloplast AS remains a premium asset in the global medtech space, deriving stability from its wide economic moat and strong defensiveness in chronic care. The performance in FY 2024-25, characterized by 7% organic growth and initial margin recovery, 28% EBIT margin, 4, validates the underlying strength of the core chronic care franchises, particularly the gains driven by Luja and US GPO expansion. The commitment to operational efficiency is further evidenced by the massive improvement in free cash flow conversion, FCF to sales, 19. The investment conclusion hinges entirely on the execution of the Impact 4 strategy. The goal of raising ROIC from 15% to above 20% by 2030, 4, requires the firm to successfully translate its strategic gains, e.g. U.S. market access, CMS coding changes for hydrophilic catheters, Intibia launch, into operating leverage. The DKK 469 million in special items expenses incurred in FY 2025 are the cost of cleaning up the organization and must be viewed as an investment in achieving the long-term margin goals. Given that the current LTM EV/EBITDA of 18.9x trades near its historical low, the stock provides an attractive entry point for a high-quality name, assuming management executes the planned margin expansion successfully. The stock is currently trading at a relative discount to its historical valuation, providing a compelling risk-reward profile tied directly to the successful realization of the Impact 4 strategy targets. Investors should monitor two critical indicators: the rate of ROIC improvement in FY 2025-26, guided towards 16%, 13, and the seamless resolution of the Interventional Urology product recall and subsequent launch pipeline.